The US government is finally making moves on crypto, with three major bills passing. Big players are buying up Bitcoin faster than it's being made. Everyone is waiting for alt season, but some are warning of a major trap first. Is this the moment we've been waiting for, or is a shakeout just around the corner? In the latest video from the Crypto Tips channel, the host argues that political moves like the Clarity Act are just theater to distract from a dire economic reality. It's pointed out that the U.S. economy is in serious trouble, using the Kobesai letter as evidence, which shows a near-record 8.87 million Americans now need multiple jobs just to get by, a number that's 800,000 higher than the 2008 financial crisis peak. The video also shows a report from Bankrate indicating that a $100,000 salary from 2020 has lost a massive amount of purchasing power, effectively wiping out the middle class. The real villain, according to the video, isn't Jerome Powell, but the Federal Reserve System itself, with a recommendation to read The Creature from Jekyll Island to understand who's really in charge. On the crypto front, the video agrees with VJ Boy that we are still early in the bull cycle, as retail investors haven't started FOMOing in yet. The final phase of this market is expected to be extremely fast and volatile. Based on a model from Midas, the peak of this bull run could land somewhere between August and September of 2025. Ethereum is expected to catch up quickly, which will likely kick off the big alt season everyone is waiting for. It's interesting to see the sharp contrast between the official economic data and the on-the-ground reality the video describes. While government reports might show a strong job market, the video's point about the rise in multiple job holders tells a different story about wage stagnation and the real cost of living. This feeling of being left behind is what seems to be driving more people towards alternative assets. The video's timing prediction for the bull market peak in 2025 aligns with many popular cycle theories. However, what makes this cycle feel different is the new level of political engagement and the introduction of Bitcoin ETFs. These factors introduce new variables that could either accelerate the timeline or create unexpected roadblocks, making the traditional cycle models less predictable than before. The discussion about ending the Fed, while a long-standing idea in some circles, feels like it's gaining more mainstream attention as people search for answers to their economic problems. In the latest video from Altcoin Daily, the channel announces that three significant crypto bills have just passed in the U.S. House. The first, called the Genius Act, is a stablecoin bill that is expected to become law. It establishes federal rules requiring stablecoin issuers to be qualified and to back their tokens one-to-one with U.S. dollars or treasuries, confirmed by monthly disclosures and audits. The video notes that J.P. Morgan predicts the $250 billion stablecoin market could double or triple within 3 years following this. This development is considered very positive for blockchains with large stablecoin supplies like Ethereum, Solana, and Tron. The enthusiasm around these bills passing the House is a big deal for sentiment in the crypto space. However, it's worth tempering that excitement with a dose of political reality. The main bill, which the video calls the Clarity Act, is actually the FIT21 Act. While its approval in the House was a landmark event, it faces a very uncertain future in the Senate, where key figures have not committed to bringing it to a vote. The White House has also signaled its opposition to the bill as it's currently written. So, while the crypto industry is celebrating a victory, the journey to becoming law is still long and full of political obstacles. It proves crypto is a serious topic in Washington, but the battle for clear-cut regulation is far from over. In the latest video from the Crypto Rover channel, the host discusses his recent trades that have already netted over $100,000 in profit. He explains that his strategy is based on a major rotation of money from Ethereum into other large-cap altcoins like Cardano and Pepe, which he believes is just getting started. He points to two big reasons for his confidence: Sharplane Gaming's announcement that they're raising $5 billion to buy more Ethereum, and BlackRock's recent filing for a staking Ethereum ETF. He believes this is the final, most explosive part of the bull cycle, which he thinks will only last for about 2.5 more months. He predicts Bitcoin could run up to around $140,000, while Ethereum will likely set a new all-time high after breaking the $4,000 resistance. He's also watching the Bitcoin dominance chart, expecting it to drop to around 52%, which would trigger a massive altcoin season. He plans to start taking profits and selling his positions in about 1.5 to 2 months as the cycle peaks. The video does a good job of capturing the current excitement in the market, especially around Ethereum. The news about potential spot Ether ETF approvals has genuinely changed the conversation, and the idea that institutional money could flow into ETH is a powerful story. The theory that this capital will then trickle down into other altcoins is a classic crypto cycle pattern that many traders are betting on right now. The $140,000 Bitcoin prediction feels very optimistic, but it reflects the high level of confidence some analysts have for this cycle's peak. It's interesting to see how this narrative, fueled by major players like BlackRock, is shaping trading strategies in real time. In the latest video from the Lark Davis channel, he talks about a historic week for crypto, kicked off by 3 major crypto-related bills passing in the U.S. House. He explains that these bills, particularly one for stablecoin clarity, are setting the stage for big banks like Bank of America and Citi to issue their own stablecoins, potentially bringing trillions of dollars into the market. He also points to a Financial Times report suggesting an executive order could soon open up the $9 trillion U.S. retirement market, specifically 401k plans, to crypto investments. The regulatory momentum discussed in the video feels like a genuine turning point. For years, the U.S. crypto story has been about enforcement actions and uncertainty. Now, seeing actual legislation like the FIT21 Act pass the House signals a serious shift in Washington's approach. This isn't just another bull market rumor. It's a foundational change that gives large, conservative financial players a much clearer rulebook. The idea of stablecoins issued by major U.S. banks and crypto options and 401k plans would have sounded like a fantasy just 2 years ago. It seems the U.S. is finally deciding it wants to lead in this space rather than just police it, which could make the flow of institutional money even bigger than what we saw with the Bitcoin ETFs. In the latest video from the Ben Cowan channel, he looks at the recent drop in Bitcoin's dominance, which has fallen below 62%. This drop is happening because coins like Ethereum and XRP are having strong rallies against Bitcoin. Cowan reminds everyone that he predicted a strong rejection for Bitcoin dominance at the 66% level, and that's exactly what happened. It's interesting to see Cowan stick to his data-driven, long-term models even when the market feels euphoric. I think his cautious perspective is a good counterbalance to the alt-season hype spreading online. While the approval of Ethereum ETFs has definitely sparked excitement and sent ETH price up, it feels like this has created a bit of a two-tiered market. Ethereum is running hard, and a few other major alts are following, but many smaller altcoins are still struggling to gain real momentum. It doesn't quite feel like the 2021 environment where almost everything was going up together. His idea that Ethereum is pulling liquidity away from the rest of the alt market seems to match what we're seeing. The next few weeks will be telling. If the rally broadens to include the whole market, then it's a different story. If not, his theory of a temporary summer rally before another move down for alts could very well play out. In the latest video from the Coin Bureau channel, Guy explains how governments are dealing with their massive mountains of debt. Instead of defaulting or hitting citizens with huge tax hikes, they're turning to an old strategy called financial repression. The video leans heavily on the work of financial historian Russell Napier, who argues we're entering a new era where this becomes the main government tool. The idea of financial repression, as presented through Russell Napier's framework, feels less like a wild prediction and more like an explanation of things already happening. When you look at post-pandemic economic policy, the puzzle pieces seem to fit. For years, interest rates were near zero while inflation was clearly present, effectively creating a negative real yield for savers. Napier's view that we're shifting from central bank dominance to government fiscal dominance is particularly compelling. We're seeing governments drive spending on massive initiatives, and the central banks have to figure out how to finance it. My one point of reflection is how this will play out in such a globally connected world. Unlike the post-World War II era, capital can now move across borders in seconds. This could make it much harder for a single country to trap capital, potentially leading to more extreme measures or creating unexpected reactions in markets like crypto, which are designed to be borderless. In the latest video from the Crypto's Rush channel, George shares some big news that has the crypto market buzzing. He explains that three major crypto-related bills, including the Genius Bill, the Clarity Bill, and an anti-CBDC bill, all passed the House today. The Genius Bill, which had already cleared the Senate, is now just waiting for a presidential signature. This positive legislative movement is seen as the main driver behind the current market surge. It's easy to get caught up in the excitement, and the video certainly captures the market's positive reaction. The legislative progress mentioned is a genuinely big deal for the crypto industry in the U.S. However, it's worth clarifying what these bills are. The Genius Bill is likely the resolution to overturn the SEC's SAB 121 rule, which makes it hard for banks to hold crypto. While its passage in the House is a strong political statement, it still faces the possibility of a presidential veto. The Clarity Bill is probably the much larger FIT21 Act, which aims to create a full regulatory framework for digital assets. It has a much longer and more uncertain road ahead in the Senate. The market's strong rally on this news shows just how hungry investors are for any sign of regulatory clarity from Washington. The optimism is real, but the finish line for this legislation is still a ways off. In the latest video from the Crypto Banter channel, the host explains that while the crypto market is looking fantastic, we should all be preparing for the first of three major traps in this bull cycle. He's anticipating a market dip of around 15% to come out of nowhere, designed to catch overly greedy and excited late buyers off guard. This isn't a signal to panic, but rather the opposite. He believes this shakeout will be the very trigger that ignites the real, explosive altcoin season. It's interesting to see this perspective because it aligns well with the general sentiment of cautious optimism in the market right now. The idea of a shakeout before a massive run is a classic crypto narrative. Looking at broader market indicators, the Crypto Fear and Greed Index has been sitting in extreme greed territory for a while, which historically points to the market being due for a correction. It's a sign of frothiness and suggests that a cool-off period would be healthy to build a more sustainable base for the next move higher. The video's breakdown of market phases A, B, C, D is a simplified but effective way to think about risk management and where to find potential value. While everyone is excited about new all-time highs, the analysis that we might need to reset with a dip first feels grounded and logical, especially as Bitcoin's momentum shows signs of consolidating. In the latest video from Crypto Wendy, she sits down with Zach, the CEO of Multibank.io, to talk about their new crypto venture. Multibank isn't your average crypto startup. They're a massive financial group that's been around since 2005, handling an incredible average daily trading volume of $35 billion. Zach explains that 30% of their traditional finance clients are already depositing with crypto, which showed them the huge potential. It's interesting to see a traditional finance giant like Multibank Group move so aggressively into crypto. They aren't just launching a token, they're leveraging their existing, massive business to back it up. The RWA play with the Ritz-Carlton is particularly sharp. The RWA narrative is gaining a lot of steam, with major players like BlackRock entering the field, but most projects are still conceptual. Multibank bringing a tangible, high-profile asset like the Ritz-Carlton on-chain with a low $50 entry point is a very strong move. Their established reputation and regulatory standing give them a level of credibility that most crypto-native projects struggle to achieve. This seems less like a crypto project trying to find a use case and more like a financial titan adopting new technology to expand its offerings. In the latest video from The Modern Investor, the host talks about the recent positive momentum in the crypto market, with some analysts expecting Ethereum to hit $5,000, which could kick off a full-blown altcoin season. He points out that despite this, many investors are still in a state of disbelief, afraid to celebrate the gains. The main story is the massive amount of Bitcoin being bought by large institutions. Bitcoin ETFs snapped up an incredible 10,900 Bitcoin in just 2 days. The host explains that this isn't new. At times, ETFs have bought up to 12 times the amount of Bitcoin mined in a single day, creating a serious supply shortage as very little new Bitcoin actually hits the open market. The video's focus on institutional buying pressure is spot on. It really does feel like the defining story of this market cycle. In previous years, the narrative was driven more by retail excitement and a vision of peer-to-peer cash. Now, the game has changed with giants like BlackRock and Fidelity creating products that funnel billions into Bitcoin. MicroStrategy's relentless accumulation, as mentioned in the video, isn't just a corporate strategy. It's a public performance that signals extreme confidence to the rest of the market. What's interesting is how this sustained, almost automatic buying from ETFs creates a floor for the price that we've never seen before. It makes the market feel less wild and more structured, which is a double-edged sword for longtime crypto enthusiasts who miss the old days.